Net, the energy sector is the one that outperformed. I don't get that part of it.
Everyone, welcome back to the channel. Yesterday, the S&P 500 did something it had never done in its entire history. It closed at a brand new all-time high. Today, it did something that almost every single record high eventually does. It paused. And that pause is actually more important than the rally itself, because how a market behaves the day after it makes history often tells you far more about what comes next than the history-making day itself. So today, we're going to slow everything down. I'm going to walk you through the exact numbers, the hidden risks, the key technical levels that actually matter, and the specific setups I'm watching heading into next week. Stay with me all the way to the end, because the final section contains the 3 highest probability ideas I'm focused on right now. Those are the ones that could move the most if this pause turns into either a continuation or a deeper pullback. Let's get into it. Yesterday, the S&P 500 closed at 7,798.99. During the session, it actually punched through 7,816. That means the combined market capitalization of the companies in the index is now sitting at a record high of approximately $70.8 trillion. Just to give you some perspective, 1 year ago, the S&P was trading around 6,400. 5 years ago, it was near 4,400. 10 years ago, it was sitting around 2,200. This has been one of the strongest multi-year advances we have seen in modern market history. But today the tone changed. Retail sales for July came in weak, down 0.6% month over month. That was the steepest drop since May of 2025, and worse than the consensus expectation. At the same time, the University of Michigan's preliminary consumer sentiment reading August fell sharply to 51. That represents an 8% decline from the final July number, and it snapped a 2-month streak of improving sentiment. Oil prices moved higher again because Middle East tensions continue to simmer, and instead of extending the melt-up, the major indexes spent most of the day in a choppy range and finished slightly lower. This is the classic new high, then digestion pattern. The critical question is whether this is healthy consolidation that sets up the next leg higher, or the first real warning that the easy upside is beginning to fade. Let's start with the technical levels, because price is the only thing that ultimately pays us as traders and investors. On the SPY, the major psychological and technical resistance remains the round number at 780. Yesterday, we got very close but failed to close above it. The first support sits at yesterday's prior all-time high area near 776.80. Below that, the more important demand zone is between 775 and 773. If that 773 to 775 pocket breaks with meaningful volume, the short-term bulls lose control and we open the door to a deeper pullback toward the mid-760s or even lower. As long as we hold above that zone, the primary trend remains intact and the path of least resistance stays higher. Volatility is still extremely low. The VIX has been hovering near the bottom of the year, recently touching levels below 15. That usually means the market is calm and complacent, until it isn't. Low volatility environments are excellent for sustained trends, but they also mean that when a real surprise finally arrives, the resulting move can be much larger and faster than most participants are prepared for. We have seen this pattern play out many times before. Now, let's zoom out to the bigger fundamental picture, because technicals never exist in isolation. On the inflation front, the recent producer price data was soft. July PPI came in flat on a month-over-month basis, and the year-over-year reading cooled to 4.7%, below expectations. That data has reduced the market's pricing for a September rate hike. The CME FedWatch tool currently shows a solid majority probability that the Federal Reserve will hold rates steady at the next meeting. However, the Fed is not fully united. Cleveland Fed President Beth Hammack publicly stated that she wants to raise rates immediately. Her argument is that businesses are eager to borrow and invest, and she is concerned that too much of that demand will eventually put additional upward pressure on prices. So while the market is leaning toward a pause, there are still hawkish voices inside the central bank. At the same time, the fiscal picture is becoming harder to ignore. The United States posted a record $432 billion budget deficit in the month of July alone, a 48% increase from the same month last year. The full fiscal year deficit is already approaching $1.8 trillion through the first 10 months. Interest costs on the national debt have now reached a record annualized level of $1.38 trillion. That equals 4.2% of GDP, the highest reading since 1997, and the interest burden has nearly doubled over the past 5 years. Interest expense is now larger than both defense spending and Medicare. This is a structural problem that does not disappear simply because stock prices are making new highs. On the consumer side, the stress is becoming more visible in the hard data. Credit card balances that are 90 days or more delinquent are sitting near the highest levels since 2011. Student loan delinquencies have climbed to the highest point since 2020. Auto loan delinquencies are near record highs. The American consumer is still spending, but the underlying data is starting to show real cracks. Yesterday's strong equity market action temporarily papered over some of those concerns. Today's weaker economic reports brought them back into the spotlight. Now we need to talk about the geopolitical risk, because this is the factor the market has been able to largely ignore for several weeks, but it may not be able to ignore it forever. Traffic through the Strait of Hormuz has fallen to its lowest level in 3 months. The United States naval blockade of Iranian ports remains in effect, and senior officials have stated that the pressure can be maintained indefinitely by rotating ships in and out of the region. The USS Abraham Lincoln has now been continuously at sea for more than 200 days. There have been multiple reports of sailors attempting to jump overboard and growing concern among lawmakers about the mental health and living conditions of the crew. The USS George Washington is being deployed as a replacement. Meanwhile, Iran is moving closer to membership in the BRICS New Development Bank and is expanding bilateral and trilateral monetary cooperation with countries including Saudi Arabia, the UAE, Egypt, and Indonesia. The Houthis have launched drones at a Saudi Aramco refinery and continue to target energy infrastructure across the region. Oil prices are responding to these developments. If crude continues to climb, the higher energy costs will eventually feed into inflation data and into consumer spending patterns. That is the moment when the equity market will be forced to start caring more seriously. So with all of that as the backdrop, record equity prices, soft near-term inflation, rising fiscal pressures, visible consumer stress, and ongoing geopolitical risk, where is the actual trading opportunity right now? I'm focused on 3 primary areas. First, the memory and storage complex, specifically names like SanDisk and Micron. These stocks have been among the strongest performers in the entire market this year, driven by the surge in demand for high-bandwidth memory and NAND flash that powers AI data centers. When the broader market enters a pause or digestion phase, these names frequently either lead the next advance or provide the earliest signs of exhaustion. I am watching very carefully how they hold their recent gains. Continued relative strength while the indexes chop would be constructive. A breakdown while the S&P is still holding support would be an early warning signal that leadership is rotating or fading. Second, Netflix. The stock received a significant catalyst after Bill Ackman and Pershing Square disclosed a new stake and made clearly bullish comments. Ackman highlighted the company's ability to compound revenue at a double-digit rate while content costs grow more slowly, which should continue to expand margins and support ongoing share repurchases. Netflix had been under pressure for months and is now attempting to reclaim upward momentum. There is well-defined resistance near the July highs in the 78.50 area. A clean breakout and hold it above that level would open the door to additional upside. Failure to clear resistance would leave the stock range-bound. This is a classic defined risk-reward setup. Clear technical level, improving fundamental narrative, and a relatively fresh catalyst. Third, the energy sector, particularly the XLE. This group has been quietly constructing a more constructive technical structure after a prolonged downtrend that lasted through much of 2025. With oil prices firming because of the geopolitical risks we discussed, energy now carries a fundamental tailwind that most other sectors currently lack. If the broader market continues to chop or begins a deeper pullback, capital often rotates into areas that combine technical improvement with a tangible catalyst. Energy currently fits that description better than most. A couple of additional names are also worth keeping on the radar. Palantir has been in a strong post-earnings uptrend since its blowout report earlier this month and is testing a significant resistance zone near 180. A decisive break above that level could trigger a new leg higher. broader semiconductor and AI infrastructure names continue to display leadership on strong market days. Relative strength in these groups is something I monitor closely because leadership tends to persist until it doesn't. Looking ahead to next week, the economic calendar is relatively light. That means price action will be driven more by headlines than by scheduled data releases. Developments in the Middle East, any comments from Federal Reserve officials, and how companies describe